Working hard for something we don't care about is called stress. Working hard for something we love is called passion.
I think it's super dangerous in any life to attach your identity to something that's unsustainable. If you attach your identity to something that you cannot sustain, when it ends, you're going to be morally crushed. The variable that I want to maximize for is not can I earn the highest returns? It's can I maintain this investing strategy for another 50 years? I know that I could earn a higher return this year and over the next 5 years if I did something different, but I'm way less confident that I could keep it going. And I think it's the same for relationships. You might be able to find a more attractive or a wealthier spouse or partner, but can you keep that going? Is it something you can maintain? I'm not interested in anything that's not sustainable. Friendships, investing, careers, reading habits, exercise habits. If I can't keep it going, I'm not interested in it. And I think the only way to really do that is if you are going out of your way to live life at 80 to 90% potential. If you're always trying to squeeze out 100% potential for something, almost certainly it's going to lead to burnout, whether it's a friendship or a relationship or an investing strategy. It's not an easy thing to do. And if you're a type A person, it's almost impossible. But going out of your way to live life at 80% has always been a strategy that I want to do just because I want to keep it going for a long time.
Welcome back, Wealth Tubers. With tariffs tightening their grip on global trade and fears of a recession making headlines across every major outlet, it's no surprise that everyone's starting to ask, are we really on the brink of an economic downturn? There's a lot of noise out there, markets dipping, confidence shaking, and big-name economists raising red flags. But before we panic or jump to conclusions, we need to unpack what actually goes into declaring a recession. Is it just about Wall Street going red, or are there deeper signals we should be watching? In today's video, we're breaking it all down. What the official definition of a recession is, who gets to make that call, and why it's not always as simple as 2 quarters of negative GDP. We'll also explore how tariffs and trade tensions are adding pressure on businesses, consumers, and the broader economy. From shrinking consumer confidence to the rising risk forecasts by top investment banks, we're connecting the dots so you can understand how these pieces fit together. If you're serious about staying ahead of the curve and protecting your financial future, make sure you're subscribed, because we're diving deep into the real forces shaping today's economy. As the U.S. economy shrinks, fears and predictions of a recession continue to grow. New Commerce Department data shows that the country's gross domestic product contracted at an annual rate of 0.3% in the first quarter of the year after growing at a solid pace of 2.4% in the final months of 2024. That decline was largely due to a surge in imports as businesses and consumers rushed to stock up on products before the Trump administration's tariffs took effect in early April. Trump's announcement of sweeping baseline and reciprocal tariffs on goods from countries around the world rattled consumers and roiled global markets, prompting pushback from Wall Street, Capitol Hill, and foreign leaders. Trump paused most of the country-specific tariffs to allow for 3 months of negotiations, though he increased tariffs on Chinese goods to 145%. But the threat of a trade war and general economic uncertainty is still making people uneasy. The Conference Board data shows that consumer confidence fell in April to its lowest level since the start of the COVID-19 pandemic, while the proportion of consumers anticipating a recession over the next 12 months rose to a 2-year high. Economists at prominent investment banks are also upping their recession predictions. In April, Goldman Sachs raised the probability of a U.S. recession to 45% in the next 12 months, while J.P. Morgan upped its risk of a global recession to 60%.
What is a recession?
A recession refers to a period of decline in economic activity. It's one of the 4 stages of the economic cycle: growth, peak, contraction, or recession, and trough. Some analysts use a rough rule of thumb to identify recessions: 2 consecutive quarters of decline in a nation's gross domestic product, the broadest measure of economic activity. But the National Bureau of Economic Research, the nonpartisan, nonprofit research organization that has become the semi-official arbiter of recessions, uses a somewhat squishier definition. It describes a recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months.
Who declares a recession?
So there are concerns within the financial world that the risk of a global recession is still a non-zero possibility, thanks to a yet-to-be-settled trade war between the United States and China that was initiated by Donald Trump.
The job of documenting the economic cycles, including recessions, does not fall to the federal government. Instead, The National Bureau of Economic Research Business Cycle Dating Committee, made up of top American economists, has been declaring the beginning and end of the cycles since its creation in 1978. There is no fixed rule about how long National Bureau of Economic Research takes to identify a recession after a decline has started. Its website says that past determinations have taken anywhere from 4 to 21 months. For example, it announced in June 2020 that the U.S. had officially entered a pandemic-induced recession months earlier, in February. It announced over a year later that the 2020 recession had ended in April after just 2 months, making it the shortest U.S. recession on record.
What happens in a recession?
A shrinking economy can cause a cascade of stressful ripple effects, including lower employment, deteriorating stock market results, and higher borrowing costs for consumers and companies. For example, people may not want to spend as much, which can impact the businesses they would otherwise support, which can lead to layoffs and in turn harm companies' performance in the stock market, further fueling the cycle. It's the consumer that's feeling the brunt of it first, and with good reason. One expert said, "The way you get to a recession is businesses see the weakening in their sales, and if they start laying off workers, then we're done. We're going into a recession."
How rare are recessions?
Various factors can jolt the economy into a recession, from unexpected events like pandemics and wars to asset bubbles bursting to excessive inflation or deflation. The U.S. has experienced 34 recessions since 1857. They varied considerably in length, from 2 months in 2020 to more than 5 years. The Panic of 1873, which triggered the Long Depression. Since World War II, the average length of a recession has been 11.1 months. The post-World War II U.S. has averaged a recession every 6.5 years. The longest post-World War II recession was the Great Recession, which spanned 18 months from December 2007 to June 2009 and was triggered when the U.S. housing bubble burst. The most recent was the brief COVID-19 recession in 2020. While the economy experienced 2 quarters of negative GDP growth in early 2022, fueling fears of a recession. While the U.S. hasn't officially entered a recession just yet, many of the red flags are already waving. Slowing GDP growth, shaken consumer confidence, and rising economic uncertainty driven by global trade tensions and aggressive tariffs. These developments may not mean we're in a full-blown recession today, but they do suggest we're walking a very fine line. What's important to remember is that recessions aren't sudden. They build over time, and understanding the warning signs gives you a real advantage. From Wall Street predictions to falling confidence in Main Street, it's clear that people are paying attention. The economy is complex, but you don't need to be an economist to stay informed. By keeping an eye on key indicators like GDP, employment trends, and consumer sentiment, you can better prepare for what's ahead. Whether you're an investor, business owner, or just trying to protect your finances, knowing how recessions work and who decides when one starts is powerful knowledge. And that's a wrap, Wealth Tubers. We've talked about the key factors that determine when a recession is officially declared and why it's so important to keep an eye on these signs. With tariffs affecting global trade and the economy showing some pressure, it's more important than ever to stay informed. And hey, don't forget to hit that subscribe button so you never miss out on anything. See you on the next one.